But for now, let's start with setting up the macro context we live in, because it's so important to be prepared for whatever will follow in 2023. So it's my pleasure to invite the first speaker of the day, Dan Bucșa, Chief Economist for CE with UniCredit Bank. Welcome, Dan. Thank you for accepting our invitation.
Thank you very much. It's always a pleasure to come home.
So Dan, it's a tough year, I guess, and it started like, I don't know, 6 months ago, more than 6 months ago. But we can look at the global macroeconomic outlook, maybe discuss the, I don't know, Fed policy or geopolitical news. But in our daily lives, we feel two indicators hurting our wealth. Inflation and interest rates, at least in Romania. I think the media and all of us are looking towards inflation and the installment that we pay at the end of the month. So my first question was regarding inflation, of course. Where do you see inflation slowing up and central banks stopping the tightening monetary policy?
Okay, so in order to say when we see inflation slowing down, we need to look at what is causing inflation at the moment. And I would split it in three. First of all, it's food prices, which in Romania are the most important, not only because they're rising very quickly, but also because food is 35%, so more than a third of the consumer basket. And it's much more than in other countries. So when you look at inflation in Romania compared to, say, Hungary or Bulgaria, they have less than 20% food in the consumer basket. So that is one point. And in food prices, there are two shocks that we're seeing. First of all, with the war in Ukraine, there was a missing supply on international markets. Romania is one of the largest exporters of grain in the world, actually. But Ukraine and Russia were number 1 and number 4 when it comes to wheat, for example. So once those countries were removed, we saw prices starting to rise quite quickly. The second phase that we are in right now is because of the increase in fuel price and energy prices generally, because agriculture is very energy intensive, especially gas intensive. There's the energy part, the fuel part that goes into producing both grains and food, and then there's the fertilizer part that is currently missing in Europe. So when we're looking at next year, we will probably have a double shock. First of all, the quantity of food produced in Europe will probably go down because of the higher costs. And second, the price will be higher because of these higher production costs. So that is with food. This year, food prices in Romania will probably rise by something like 30%. Next year, we're hoping for a halving of that, but still 15% is going to be quite a fast pace of growth in food prices. Then energy. Here, I would say I'm a bit more constructive than what we're seeing right now in the market, because everyone's focused on gas and whether we have enough natural gas in Europe. And I think we already do. So we looked at different scenarios of how we will consume the gas we already have in storage, and also the gas that we're buying from other sources than Russia. And the countries that matter for us the most, so that would be Germany, Italy in Western Europe, and then us, the Poles, the Slovaks, it looks like we will have enough gas. It's true that we might have to sell some gas, or actually to give some gas to Moldova. And the countries that are lacking enough gas at the moment in the region are Hungary and Serbia. So hopefully, once Europe stops buying at any price, the way it does right now, gas prices will go down. And we're seeing now the first phase of a European deal to lower gas prices and hopefully also energy prices. So I'm assuming energy prices will also go down next year. And then there's a part that is influenced by domestic demand. And in Romania, domestic demand was extremely strong in the first half of the year. People front-loaded their spending. They saw prices increasing. They knew that interest rates will increase, so they just bought much more. And actually, all the precautionary savings that were accumulated during the COVID time, which was roughly 4% of GDP, was spent within 6 months. We're not the only ones who just went through all those precautionary savings. The Poles did the same, and the Slovaks did the same. And now, in order to have an increase in this core inflation, in retail sales, we would need very high wage growth and growing lending for consumer lending, let's say. And we're not seeing this consumer lending growing anymore, and also wages are not growing in line with inflation, at least in Romania. Actually, in very few countries they do. So I'm assuming inflation next year will be slowing from, I don't know, 17, 18% this year to something like 8 to 10% in 2023, and then even lower in 2024. Something that I think it's very important to say is that wages always trail inflation. So it takes a while before employees ask for higher wages, but once they see inflation taking up, then they tend to ask for higher wages for a longer time. So I'm assuming wages will be growing at a fast pace also in 2024, not only in 2023. So that means that by 2024, I don't think that inflation will be back at 2-3%.
Got it. Going back to interest rates, I know that some economists and investors said that the probability of a soft landing is pretty dim, and central banks would have to increase rates over CPI to have a chance to fight inflation. What's the UniCredit-based scenario regarding interest rates? I mean, how much the national bank will increase the rates before having a chance to fight inflation?
So here we have two components. One is the international one. We have two markets that basically determine what monetary policy looks like also in the rest of the world, and those would be the US and Europe. And in the US, we expect the Fed to increase rates to 4.75% by late this year. And then in Europe, we expect rates at 2.75, so much lower than in the US. And the reason for this difference is that in the US, inflation is much more determined by consumption, by demand, while in Europe, it's mostly the supply shocks, gas prices, food prices, and so on, something that the central bank cannot do anything about. I mean, the ECB can take interest rates to 10%, it's not going to lower the price of gas.
Yeah.
And that's why we're saying it's an exogenous shock for the central bank. So going back to the region, as you know, they started increasing interest rates much sooner than both the Fed and the ECB. And we're thinking that they're close to the peak. And there's been a change in the way they look at monetary policy, because at first they started increasing interest rates, but then they decided that they have to combine those with interventions in the foreign exchange market. And we've seen these interventions being larger and larger. The Czechs have spent this year more than 20 billion euros on interventions. The National Bank of Romania has been intervening more than anyone else through the years. So this year it's been just a regular year for the National Bank of Romania, while the others are learning how to do it. The NBR has a lot of experience. I think the NBR will stop hiking at 7, not necessarily because that's the level we need, but that's the level where the Czechs and the Poles are stopping, so it's more like a beauty contest, who is higher than whom. And I see them all three there at 6.75, 7. With Hungary much higher than that. But then when we're looking to next year, because we're seeing inflation being high in all these countries, I don't think we will have many rate cuts as well. So I think the NBR may be at 6% by the end of next year.
So we should expect interest rates for loans at higher levels at least 2 years?
I think more.
More, okay.
Yeah.
Okay. For those people, for the people with minimum wage but also for the middle class, I guess that this might be one of the worst periods in the last 15, 20 years, I don't know. But from a macro perspective, what should we expect in the following period? And I mean, unemployment, limited growth for the companies where they are employed, things like that.
So I was saying that this is a peculiar time, and if we will have a technical recession, we think we will have a technical recession everywhere in Europe over the winter. So GDP will fall in the fourth quarter, so this quarter and the next one. But when we're looking at a consumer, we're seeing something very peculiar, because usually when a recession starts, the consumer turns extremely pessimistic. And what they usually say is that I might lose my job, probably my wage is not going to go much higher, I won't have money to spend. This time around is very different, because this time around consumers are actually saying, no, I'm actually fine, but the rest are not. So that tells you something about how well the consumer fared until this slowdown that we're seeing over the winter. And I'll give you just two examples. So there's this sentiment indicator that we have for every country but Romania, unfortunately. And sentiment indicators fell abruptly when the war started. It was normal, we were close to this war, people were very worried. But then we have another sentiment indicator that shows how much people intend to spend over the next 12 months. And I'm not talking about food, I'm talking about high value spending. So cars, flats, electronics and so on. And this one is extremely resilient. So people still see themselves spending a lot of money in 2023. And they wouldn't be doing that if they wouldn't think that they will still have a wage or they will still have some savings. So this is the very different part of the picture to other recessions that we've been through before. So this is going to be a recession caused more by the fact that on the supply side, on the production side, we will have some factories, more factories closing down because of the cost of electricity and gas. But let's not forget that in Romania and generally the region, the sectors that employ more people than the others, and this would be in industry, electronics, machinery, cars, then construction, then retail. These sectors have been extremely resilient, and they remain very resilient. And especially for those in manufacturing, we're seeing their orders actually increase. Even at this late stage, we still see orders increasing.
Okay, I will go for a bit into I don't know, not necessarily politics, but I can see a resemblance with 2007, at least in how the government is looking at the crisis. In Europe, there is a slowdown. I guess it's recession in some states, in some countries. But does this mean that Romania will follow into a deep recession? Because you said already that there will be most likely a technical recession.
Yeah, I think that we can't compare it. What we have now to what we had in 2008. It's very different from several points of view. First of all, on the consumer side, the financial situation of households is much better now than it was in 2008. Then when we look at the level of debt that households have, and also the value of flats or houses or housing generally, if we adjust the price of housing with wage growth since the global financial crisis, since 2008, Romania and Bulgaria are still below the level of 2008. So wages increased much quicker than housing prices. And it's only these two countries. Then if we look at another way at it, Deloitte has this measure of how many years it would take, given the wage, an average wage, to buy a 70 square meter new flat in every country. And they say that between 4 and 6 is where you can afford easily to buy a house. So Romania is at 6.3, we're there narrowly. Bulgaria is below us, Germany is right next to us, but everyone else in the region is somewhere between 10 and 14, right? It takes double the annual average wage to buy a 70 square meter flat in Czechia than it does in Romania. So when we're talking about the risk of a bubble in the real estate market, we're far more worried about the middle Danube basin, so that would be Czechia, Slovakia, Hungary, Austria, than we are with Romania and Bulgaria. And I think that's very important, because part of the decline in economic activity in 2009, 2010 was brought about by households being hammered by the increase in interest rates. So that would be the first change. You said that when you're looking at the government, it reminds you of 2007. I don't really agree. I know what they're talking, but I see what they're spending. So the budget deficit after 8 months is around 2.4% of GDP.
Okay.
It's one of the lowest in the region. They will get a lot of revenues from these extra windfall taxes on energy. By the way, they have no idea how much. So I asked them, so what's your estimate? They don't really have one. It's not necessarily reassuring. But when they will start spending on subsidies, truly, during the winter, I think they will have enough money from those taxes to cover the subsidies. I'm more worried about what will happen to energy providers, distributors, because that's where we're seeing the crunch at the moment, than I am with what will happen to the government and whether the government will have money. I think the government will have enough money.
Okay, good to know. Okay, going to the banking sector, what should we expect from the banks during these times?
I've been on a tour now for 5 weeks, going through the region and talking to companies and to customers, and everyone comes to me and says, why are always banks stop lending when the crisis comes? Because we're a company. We're not an NGO, right? I mean, we are as cyclical as any other company out there. So it's normal for us to tighten the belt the way the rest of the private sector tightens the belt. So I don't expect banks to splurge on new lending going on. I think there will be types of loans that will be more resilient. When we look at Romania, for example, consumer lending is down quite sharply. Mortgages, not really. And I'm talking August, but now they're also slowing quite quickly. But then credit to companies actually increased over the summer. And it's not unusual because companies like to have more liquidity going into an uncertain period, right? They want to be a bit more liquid because they don't know exactly how the fund flows will look like. So if I'm looking at the region, this is a general picture, with the exception of a few countries where the central banks are playing some weird games. Again, our neighbors from Northwest. I would say everywhere the picture is the same. The consumer stops first, mortgages will probably follow with a delay, a short delay, and companies last.
Thanks, Dan. Now I will ask you for some advice. In general, it's hard to predict, but I don't know, easier to prepare, I guess. What would you recommend to the common people during these times so they can navigate the crisis more smoothly?
All right. I hate preaching, I have to say that. I was supposed to become a priest, but luckily my dad interrupted the line. So every time people say, so what's your advice? I'm like, I'm not in the right spot. The regular common sense advice, don't spend too much on investment as long as you don't know what your outlook will be like. But here there are caveats. I've been around the region, for example, looking at companies that operate in non-ferrous metals, which this sector is extremely intensive in energy. Moreover, if you stop producing, let's say, aluminium, it's very difficult to restart that factory. So we know that these factories are doing pretty poorly around the region. But then we find one or two, who are the last ones left, basically, who say, well, I have all the market to myself. You can't tell me I should not expand because I think I'm just going to buy everything in the region if I can. So there are possibilities like that, and I think this is the way you should think about it. If you plan wisely for the next 6 to 12 months, you might be in a position to increase your market share come late 2023, when hopefully we will have the end of this. I mean, the second half of the year, we think that the European economy can grow again. What we need for that and what you should follow in order to have this recovery, we need Europe to secure enough energy for the next winter. And here I would say we're still planning quite poorly. I don't know if you've seen Qatar, they're quite frustrated with the European attitude, because Europeans went to Qatar and said, yeah, we want to buy gas for next year, but we want a very short contract with variable prices. And Qatar said, you need the gas, I don't need to sell. So it's going to be on my terms. And my terms are more than 1 year and fixed. So I think we should give up this kind of tricks that some of the larger European countries are playing at the moment, because we really need that gas. Moreover, Europe can borrow, common borrowing, and cover the difference, the cost difference, so that our companies can be efficient. This energy crisis will shape the medium term for sure, because if prices stay so high, we will not be competitive when we compare ourselves to other regions. Look at the amount of stuff we're purchasing suddenly from Latin America. Usually we were not buying much, but now from coal to gas to all sorts of metals to fertilizers, right? Trinidad and Tobago, did you know that? Well, it's the biggest exporter of fertilizers to Europe at the moment. So we need to make sure that within 3 years we are competitive on the market. And for that we need politicians to come together and reform the energy market in Europe. So keep an eye on that, because that's going to be the main signal of when we will re-emerge from this hopefully shallow recession.
Okay, Dan, we almost run out of time, but we'll have 1 minute for a question from the audience, if it's the case. So if anyone should ask Dan, now is the right time. We have microphones.
I think I anesthetized everyone.
Okay.
Yeah. There's a question there. It will leave me 5 seconds to answer. So hopefully it's a yes and no.
Okay, so here's the question. Do you see an increased activity in derivative trading? I'm thinking futures, interest rate swaps, MBAs.
Yes. I think another lesson that we need to take from this crisis is that when we entered this commodity crisis, in Central and Eastern Europe, commodity hedging was almost non-existent. There were very few companies. When I'm looking at our German bank, 90% of companies were hedged against commodity prices, 9-0, from all sorts of sectors. So I think the first lesson we should learn is that a company should not be gaming, I don't know, foreign exchange markets or even interest rate markets. You do have the instruments to hedge against risks. Obviously, you're not going to do it at the height of the peak of prices, but I think this market will also develop in Central and Eastern Europe, yes, more than it has at the moment. Thank you.
Thank you for the question, and thank you for being with us today.
Thank you very much for the invite.